So there's an old saying amongst investment professionals, if you know one family office, you know one family office. So we're lucky to be joined next by 3 leading family office professionals who will be laying out the tactical case for using alternatives to future-proof wealth. Please welcome to the stage your next moderator, Peter Tarrant, Managing Director, Business Development at BTIG, a platinum sponsor of Global Alts 23, and his 3 panelists. We have Jamil Bacha, Investment Director at Waycross, Jenny Heller, President and Chief Investment Officer at Brandywine Group Advisors, and Isaac Septon, Chief Investment Officer at Observatory.
Great. Thanks so much for that intro. That was tremendous. We've got an incredible panel up here. We've got over 30 years of family office experience sitting in front of you. I've been doing this for about 20 years, and I've met a million managers and strategies, and I can't tell you how often I hear, well, I just need to meet a family office. They're going to buy this. So you're literally seeing the modern penicillin because they buy everything. No, they don't buy everything. But I'm supposed to filter that out, and my team filters that out, and I feel a little sorry for them that they must experience the same thing that we do, that everyone thinks that they're just wholesale going to buy their strategy. And I think that gives them an extra challenge where they really have to filter a lot of information. But let's kick it off and talk about the current environment and what family offices are really doing. Jamil, I'll start with you, just sort of talking about last year and this year. I know personally I was excited when my Bloomberg screen reset and I didn't have to look at double-digit down numbers and all the indices. But with last year, with growth getting slaughtered, talk of credit getting more interesting, certainly a big debate about Asia. Like, how are you guys thinking at Waycross about 2023 and looking back at 2022? What do you think about the environment?
Sure. So we take a more bottom-up approach, and 2022 was hard in certain portfolios, right? Things more equity-oriented, growth-oriented. But our diversified portfolios that our hedge funds did phenomenally well. And we're super excited about that. We take a long-term approach, and so there hasn't really been much change, right? We're trying to find the best managers that can fit a certain mandate, whether it's lack of correlation or credit or equities or growth or whatever, and kind of layering in over time. So for us, it's kind of just more the same and just kind of being cognizant of it. As taxable investors, you are paying interest on your income.
Right.
So income on your interest. So not that much change there.
Okay. How about you, Jenny?
I think last year was a couple of things for us. We also don't tend to be tactical, but over the prior couple of years, sort of carefully pulled some of the beta out of our portfolio, just recognizing how extraordinary the environment was. So it was sort of a year to test the mettle of the portfolio a little bit and see how it performed in a really tough market. There were some really positive surprises there. There were a few negative surprises as well, but overall the portfolio sort of did its job. And it was an environment that allowed us to add to some strategies that had been hard closed for a number of years, or new relationships that we'd had a hard time building just because the managers were underperforming or their markets weren't doing well. And the nice thing was, sort of over the course of the year, you got to see some of those things start to play out really positively. So that was great. In terms of this year, we started to look at credit a little bit last year. We have a fully built portfolio, so everything we add is at the margin. And it started to look interesting to us, but not enough to necessarily dedicate a full strategy to it. So it was sort of watching our managers shift in that direction. And I think we're open-minded to the possibility that maybe there will be something tactical to do, but we always underwrite to after-tax returns. Things have to be really, really dislocated for them to make sense for us in that regard.
Right. How about you, Isaac?
So for us, we are a top-down family office, so we try to focus on what are the best opportunities, whether it's by geographies, sectors around the world. and then we make a decision of where to allocate capital. So looking at 2022, 22 is actually a decent year for us. We're actually positive because a lot of the things that we did starting in 2021, reducing risk capital, directionality. Looking at 2023, we're less pessimistic than we were in 22, but still somewhat pessimistic about 2023. And as a result, some of the strategies we're looking at are less directional, more tactical trading, volatility oriented, managers who can deploy and trade capital irrespective of the directionality of the market. And I think that will probably continue to be a theme into 2023 unless we get some major dislocation in the financial market, at which point I think, to your example, there'll be much more distress, at which point we can be a bit more directional.
I think one of the big challenges with family offices is we all try to bucket things. It's how our minds generally work. It's how we want to interrelate things. And one of the big challenges with families across the three of these is that they're all different, right? Like, it's not like three fund of funds up on a stage. And nothing wrong with fund of funds, but every family's different. Some families are really old and have been around forever, like Waycross. And the story of how your family office came together is unlikely, but about half the age of his. And Isaac's been doing his job for Observatory for over 16 years. But every family has different needs. Isaac can be tactical, but Jenny needs to be tax efficient. So I think people misunderstand that a lot. Can you guys talk about the trade-off between being tactical versus seeking tax efficiency and why that's so important long-term?
Yeah, as a family office, you have a lot of money, which means you're going to pay a lot of money in taxes. Since we take a long-term approach, you can be tactical, you can choose asset classes, but in the end, we're allocators, right? Like, we're not in the trenches, right? And so you have to build some kind of relationship with your managers, understand what they're doing, know when to redeem, right? But everything I underwrite, I just underwrite with a 30 to 40% haircut. Like, high turnover strategy is if you make 10 net, you're making 6, right? And you might make 7, but that's just what it is, right? So if you have like I used to be at an endowment, right? 8%, uncorrelated, smooth, is amazing, right? Paying 40% on 8 changes your calculus a lot. And we, a lot of times, don't look at those strategies. And it's just what it is.
How about you, Jenny?
Yeah, we're pretty specific about how we think about it. So focusing on our hedge fund portfolio, we won't invest in anything unless we can underwrite it to a 5% post-tax, post-fee return. And if it's at the lower end of that range, it has to be totally uncorrelated and relatively liquid. And then we'll start to make trade-offs. Like, if something is illiquid, we expect a higher return. If something is correlated, we expect a substantially higher return. And we will, with every manager that we can, we will actually take all of their historic K1s, run them through a model, understand what we think their post-tax return is going to be. You're right, conceptually, often a lot of strategies we look at will end up in that kind of 60% tax efficiency range, but sometimes we're surprised on the upside and on the downside. So, and we've started doing this over the past, 7 years, because I made so many mistakes on the tax side. When I joined Brandywine, I came from an endowment. I never had to think about it. And then we'd get these tax bills, and I was like, oh my God, I screwed that one up. So, we really had to hold ourselves to account. It doesn't mean there isn't room for tactical strategies. We invested in a very tactical sort of oil and gas related strategy a few years ago, which we knew was going to be to buy a very small subset of stocks and sell them once the market recovered. But we underwrote it to a multiple of capital. So then it was okay.
Okay. How about you, Isaac?
So taxes, so our family is New York City based, so taxes are very important. But we did an analysis for our founder, and we actually continue doing it every year, of, so we're 100% exclusively in hedge funds. If we invested in an S&P 500 like type product, with our cash flow needs, et cetera. On an after-tax basis, even with all the hedge fund fees we pay, we've still done better than just the ETF. Now, the other issue with tactical versus tax efficient, tactical means you potentially have lower drawdowns. Taxable means you have to sustain larger drawdowns, because every time, even if you thought the market's view is negative, you can't just fire a manager, redeem, realize the taxable, income or loss, and then in 6 months or 18 months, reinvest. So it's another trade-off, not only between taxes, it's also between, potential drawdowns. So we rather have lower drawdowns. Yeah, we pay a bit more taxes, but I think, higher Sharpe long-term is probably better for our family office.
Right, right. Well, obviously we all saw interest rates rise last year. And it sounds like they're going to keep going this year. Big change for the markets, big change for portfolios. Like, what are you guys doing in terms of positioning your outlook, maybe changes in the portfolio to accommodate, this new regime? What are you guys doing about interest rates?
Yeah, so we're definitely looking at a lot more, strategies that are going to do well in markets with a lot of dispersion, right? And a lot of those guys got canned like the last decade, right? Like, you meet a ton of hedge funds, people who are risk managed, who made 5% annualized, and the S&P was generating 14. You're like, this is stupid. Like, why would I ever pay you money to make me 5%, right? That world might be back, right? With positive interest rates, dispersion in markets, if high yield spreads widen out, if there's geopolitical instability, those are the people you're going to want to find. And it's a much, much tougher job today than it was a decade ago.
How about you, Jenny? What are you guys doing about interest rates?
Yeah, we've never run a lot of duration risk in our portfolio, again, because credit's been hard for us to begin with, and because this risk was sort of staring us all in the face, we just didn't know when it was going to happen. I think it's potentially an interesting environment for lower net long short strategies. So, anything that wasn't just trading on beta the past couple of years. So we'd started some of those relationships. This is a really nice environment to be adding to them, where we actually expect managers to start making money on their shorts again. We struggle because I think some of the strategies that are going to do well in this environment, we just don't invest in. We don't invest in macro. I think it's a really interesting environment for macro, as we saw last year, but it's not in our wheelhouse for a number of reasons. So we're trying to sort of search around the universe for things that are uncorrelated that maybe can benefit from this environment, but I wouldn't say it's totally clear that the direction of interest rates will impact them. We're finding interesting things to do in spaces that have nothing to do with rates. It's a super hard market for insurance right now.
Right.
So we've been adding to insurance strategies because we're like, it might be still kind of a painful market for equities, but this is just sort of off to the side and kind of another part of the market that's been super distressed that no one's paying attention to. So we're also sort of at the margin adding to stuff like that, but we're a little bit constrained, I would say.
Yeah, really interest rates haven't affected or changed the way we look at strategies. I will tell you that given the longevity of all of us basically not earning interest income, we've now come to some of our trading-oriented managers and said, hey, now we're earning 4% risk-free. You can't charge us performance fee on that 4%. If you remember, if you go back years ago, managers never used to get paid. It was like LIBOR plus something.
Right.
I think a lot of us have to go back and say to the managers, hey, I'm not paying you 20% on my 4% or 80 basis points just because you want to. And some of the managers are smart, saying, yeah, I think that's very logical. Actually, one of them sent us the invoice this year in one of our SMAs and actually excluded, without me even asking, the interest income, even though it wasn't in our investment agreement.
That's interesting. So what do you guys think about fees now? Where do you think the market is for fees in terms of what a hedge fund can charge, and that you guys are like, okay, or that's too high? Are they coming down? Have they settled somewhere? How do you guys think about that as an organization?
Yeah, this is going to be the worst answer ever, but it just depends. If a manager has performed or is capacity constrained, it's supply and demand, right? If someone's performed or capacity constrained and has a gajillion dollars of them and everyone wants to follow Yale, then they're going to charge whatever they want, right? And they're going to get it, and that's game, right? If there's an emerging manager and they're struggling, you can negotiate it, But if you're like a standard like long short funds or whatever, then yeah, we've seen things come down. Like when I started my career, everything was 2 and 20. Now you're seeing things like 1.5 and 20, like 175 and 17.5, like whatever, right? So they have come down, and that's a supply-demand thing, and there's just a lot of competition out there, and markets are hard.
Right.
I think I have seen a substantial shift down over the past 5 to 8 years. Some of the really blue chip managers that have been spinning out, there was a period, let's say 2015, when they could have easily raised at premium terms with long locks. They can't do that anymore. I mean, they can still raise large amounts of capital, but they have to do it on terms that are more investor friendly. They have to have a founder share class. Often they have to be a bit more liquid. It's at the margin, but I do think, especially in the long short space, just because so many long short funds haven't been able to keep pace, and frankly, a lot of the blue chip ones that everyone thought would do well have run into trouble. I think the bloom is off the rose a little bit. Not that I don't believe in the strategy, but it's just forced managers to rethink their level of alignment at the margin. I also think we've seen more creative fee structures become the norm. Whether it's kind of frequent flyer discounts or declining management fees with asset growth, or you name it. And we've even seen some of our older hedge funds have to rethink their fees in order to keep people happy. And they've kept those structures in place as they've started to perform. So it's good news at the margin.
Okay.
So for us, because we invest predominantly in emerging hedge funds, if a hedge fund, so I think almost to Jamil's point about it depends. If a hedge fund has very strict capacity limits, we're happy to pay them 20%. I think it's valid, etc., because you want the hedge fund manager to earn a rate of return for themselves. But if the hedge fund is a bit more generic, I would say the average that's fair is probably 1 in 15. I think that's something a bit more reasonable.
1 in 15.
I don't think 2 in 20 makes sense, especially to your point, like if they raise a lot of capital, like if you think about $1 billion type firm and charging 2% management fee, $20 million just for showing up, and then obviously talking about fees, the other hidden fees is when you read the PPMs, what other fees are they, pushing, onto investors? It's probably another 1.5 points. All of a sudden you're paying 3.5. So it really depends, but I would say normally 1.5, 1 in 15. If it's capacity, maybe a little higher.
Thanks. For me in business development, I feel sorry for all the people that I target and go after. I've got Bloomberg at my hands, I've got LinkedIn, I've got email, I've got phone, I've got text. I think really a good question for this audience is, if you have a great strategy and it's unique and you're gonna articulate how it's differentiated, like how does that manager get to you and approach you in this environment, right? Like last year, everyone was marketing. This year, even more people are gonna be marketing. So, what would be your advice to somebody who wants to talk to you about their strategy? Is it an email? Is it a phone call? Like personally, I hate unsolicited phone calls. Don't call me. Send me an email. What is the best way to get on your radar and the best way to politely follow up?
For me, email is by far the easiest. I try to respond to most of them. I take a lot of meetings because I find that I can learn something from every meeting, and 95% of the answers are no, but hopefully I can help you with how investors think or other people to talk to or something like that. And follow up, a normal follow-up's fine. Hey, I emailed you a week ago, I didn't hear anything. Okay, cool, sorry, So for me, pretty simple, email's the best.
And a lot of Zooms, right? Because you're in the Midwest.
Yeah, please, if you visit, I will buy you a beer. It is -8 degrees today in Minneapolis. Bring a sword, we got to fight some White Walkers, like Jon Snow up there. Much kudos to the people who show up in Minneapolis.
Oh, good. How about you, Jenny? What's the best way for people to get in touch with your team?
The key is my team. I have a lot of people reach out to me, and I try to be responsive. I was told by a friend last night that I'm notorious for being unresponsive, so I guess I'm not trying hard enough. But the truth is, I am not the main decision maker on my team. I really, we have a collaborative process, but I find that when I bring things to the team to work on, they are much less interested in them than when they have discovered them themselves. So email is definitely the best way. I think people aren't always as thoughtful as they could be about what they put in that email. I mean, be thoughtful about what you write, be specific about, you have to sort of differentiate yourself in the 20 seconds someone's going to take the time to read it, or personalize it, or mention someone that a friend you have in common. I mean, if I'm being straight, like, people are more likely to respond in general if there's sort of a warm connection. But yes, emails and to my team is better than to me, because when things come to me and I push them out into the world, in some ways, like, my team discounts it more.
So for us, it's email, but I would say make sure you understand each of the different family offices here. Make sure that the strategy actually fits their mandate.
Yeah.
A lot of us probably have websites or can probably read articles about us, etc. Make sure you do some homework. So, like, for example, we don't invest in $5 billion private equity shops. I mean, just using this conference, I probably got 20 emails from $5 billion plus private equity shops. Hey, can we have a meeting? And that almost is a bit of a turnoff. So if you're an emerging manager, put your, presentation, maybe a letter, put some returns. And we're like 99.9% of the time always responsive. Because again, it's just building that relationship with the emerging manager community.
All right, we probably have time for one or two more questions, depending on how long the answers are. But let's bring it full circle to the panel. Talk about some issues around future-proofing, looking back and looking forward. I'd love you guys to touch on two topics. Growth tech, is it dead, right? I mean, that just destroyed some portfolios last year. And Asia, what are we going to do with Asia, right? Like, it grows, but it's hyper growth, but then it's hyper down. Maybe you can't get your money out. Like, how are you guys thinking about growth tech? And how are you guys thinking about Asia?
Sure. We've got exposure to both. Growth tech was obviously painful last year, and the 10 years before it was amazing, right? Still have allocations to it. We always will. It'll always be a part of the portfolio. We're not cutting bait, anything like that. We've got an investment team of 5. And I've spent most of my career in Asia. So I'm definitely the Asia bear, the Asia cynic, whatever you want to call it. And my colleagues who haven't spent as much time are much more bullish. But my parents are Indian. I went to India in the 90s and stuff, and India's changed. It's grown, and the availability of services and goods is amazing. Hundreds of millions of lives have changed. It's amazing. How much money have foreign investors made in India? Sustainably, right? Like, you can pick like one fund, do it for 5 years, make a bunch of money. That's great. But like, how many 20-year relationships on an annualized basis have made money for the amount of like effort you had to put in? You have to think about like politics. You have to think about like FX. Like, is there going to be like a Taiwanese-Chinese war? Like, is like Modi going to destroy India? Like, is Xi Jinping going to destroy Chinese real estate? Like, these are debates we don't have in America when you think about like, I'm going to pick X manager to invest in like med tech or like retail or something, right? But you have to sit there and be like, oh, Chinese household income, how does it affect retail, blah, 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 blah. It's much, much harder. So I'm usually the skeptic.
Got it. Jenny, how about you guys? Why don't you comment on Japan as well?
Okay. Growth tech, yeah, we've always had it. We always will. In spite of I think people forgot that tech has always been cyclical. There are secular growth stories within it, but if you look at the actual performance of the tech sector, it has long cycles, but it's always been cyclical. So I just think we sort of forgot that for a minute. But it doesn't mean there aren't extraordinary business models within it, and a lot of innovation, and a huge amount of talent, and a lot of cash flow. You just have to sort of find it. So we're going to continue to take that ride in the context of a diversified portfolio. Asia, yeah, there's a lot of parts of it. Japan, I think, is a really interesting market from an alpha perspective, but we aren't doing it because we're we have a very narrow mandate on the long-only side to invest in quality and durability with like a 20, 30-year view. And the parts of Japan that I find most interesting as an institutional investor, I mean, it's the sort of hostile activism market, and it doesn't really fit what we're doing, and I don't like it enough to want it in my hedge fund portfolio.
Right.
But I do think it's interesting, even though tons of people have gotten burned. And China, selectively, yes, very selectively, but I think it's too big a market to ignore. Also think there's some really interesting, wonderful businesses in the Asian markets, but again, it's sort of at the margin and you've got to rifle shot it.
How about you, Isaac? How do you look at growth tech and views on Asia?
Yes, I'm actually not just a data point on Japan. Actually, myself and my colleague actually just came back from a week in Tokyo. And it was my third trip, first after COVID. I mean, it was booming. I mean, again, you know, a lot of us think maybe Japan, you know, is just going to stay this way, but I mean, it really felt very different for this third trip. I mean, things were booming, and you didn't even have the Chinese, you know, tourists there. So I'm going to answer your question a little differently. I love growth tech. I love Asia, but you got to pick the right strategies to take advantage of the nuances and the inefficiencies in the market. So to Jamil's point, would I just be directionally long Asia? Maybe yes, maybe no, depending upon valuations. But those markets tend to be inefficient. They have, you know, less coverage, less what we would call, let's say, talented, you know, managers. And if you can find a talented manager who can take advantage of those situations, that's how you make money, even if the markets don't go up.
Great, great. Well, it'll be an interesting year to see how we do. I just want to thank everyone for coming on the panel today. It's really an honor to sit here and get a chance to talk to you guys. And, you know, I wish you guys well out in the conference. Thanks, everyone, for listening to us. That's about all the amount of time that we have. But if you have questions or follow-up, please get to me or please get to the panelists, and we'll take it from there. Thanks.